Welcome to The Explainer, folks. I'm your host, and let me tell you, today we're decoding an absolutely fascinating session on Dalal Street. If you've been watching the screens at all, you know today's tape was a classic tale of mixed momentum. From wild intraday swings to massive sector rotations, we are breaking down exactly where the smart money is moving right now. Here's a quick rundown of what we're covering in this explainer. We're going to kick things off with a market snapshot, dive straight into decoding that wild intraday tape, unpack the massive sector rotation we witnessed today, zoom out for the big macro themes, and wrap it all up with the final verdict. Let's get right into it. All right, Section 1, Market Snapshot, a bullish day. Despite some underlying turbulence out there, the headline numbers confirm one thing: the buyers are firmly in control. The Nifty closed out the May 20th session of 0.17%. But hey, the real story here? It's the liquidity. We are talking over 1,14,500 crores in total traded value. I mean, that is just massive liquidity. With nearly 35 million trades executed, yeah, this wasn't just a quiet day at the office. This was a highly active session, with institutions aggressively moving capital around. Okay, let's dive into Section 2, decoding the intraday chart, looking at price action and psychology. Because to really understand how we manage that green close, we gotta unpack the intraday tape. Look at what happened right at the 9 a.m. open. We get this sharp gap down, right? A sudden spike lower near the 23,270 mark. Now, for the retail trader, that looks like pure panic. But for a seasoned analyst, that's a classic early shakeout. They're just hunting stop losses to shake out the weak hands. And notice how incredibly fast the buyers stepped right back in. By 9:20 a.m., all that early selling was completely absorbed, and we started seeing this beautiful, steady, bullish momentum building up. Now, what's really interesting here is this key resistance level right at 23,620. Throughout the midday session, the index tested it, backed off, and kind of just consolidated right below it. This is textbook accumulation, folks. Then, right around 2 p.m., boom, we get a massive institutional breakout. That afternoon surge absolutely confirms that institutional buyers took firm control, driving the market to close right near its daily highs. So what does this all mean for us? How do we actually trade this structure? Well, a higher high, higher low trend day flashes some super clear bullish signals. The strategy moving forward, based on today's tape, is straightforward. Number 1, look for buying opportunities on pullbacks that hold above that 23,620 breakout level. 2, you want to target trend-following entries after periods of consolidation. And 3, of course, always keep a trailing stop below those intraday swing lows. You got to protect that capital. Moving on to Section 3. Sector rotation, winners and losers. To truly grasp today's Nifty, we have to look under the hood and see exactly where the capital is flowing. Today was basically defined by an intense tug of war. On one side, we've got the real economy, cyclicals, energy, and infrastructure. These sectors are absolutely surging. But on the other side, the digital and defensive economy, tech, telecom, and FMCG, well, they're really lagging behind. It's crystal clear. Investors right now are actively choosing tangible assets and industrial components over defensive positioning and pure software growth. And the tape brilliantly illustrates this divide. Just look at this. Nifty Energy was the undisputed heavyweight champion today, posting a massive 585-point gain. That is strong bullish sentiment right there. Nifty Bank gave us a solid foundation too, up about 153 points. But look at the bottom half of the board. Nifty FMCG took a really heavy hit, dropping almost 363 points in a massive wave of profit-taking. And Nifty IT? Still weak, shedding another 122 points. Drilling down into the specifics, we're seeing high beta plays like MTR and specialty manufacturing aggressively leading the charge. The market is heavily rewarding companies tied to infrastructure resilience. Meanwhile, banking is holding steady, but it really seems to be waiting for clearer macro signals on domestic credit before making a major directional move. And IT? Well, it's pretty much stuck in a wait-and-see consolidation mode thanks to those broader global headwinds. Now, before we look at the big macro picture, let's quickly check the pulse on the India VIX. For those who need a quick refresher, this is our market fear gauge. It measures near-term volatility expectations, giving us a direct, real-time read on market sentiment. Today, the VIX dropped down to 18.44. And folks, this is a crucial psychological shift. Decreasing fear means a robust return of investor risk appetite. The market is essentially telling us, hey, we feel confident enough to buy into this upward momentum without constantly looking over our shoulders for a crash. All right, Section 4. Key macroeconomic market themes. The big picture. Let's step back from all the intraday noise for a second. What are the fundamental drivers behind this massive rotation of capital?
We've got three main drivers shaping the tape right now. First up, the China Plus One strategy is in full effect. Global supply chains are diversifying, and Indian industrial components are perfectly positioned to capture that shift. Second, in this high interest rate environment, the whole market narrative has changed. Investors are pivoting hard. They want companies with tangible, repeatable cash flows, not speculative, pure growth tech stories. They are highly focused on the realities of high capital costs.
So ultimately, the bedrock of this current rally comes down to these three pillars: robust domestic consumer spending, solid corporate health, and massive government infrastructure capital expenditure. If a company is out there building the physical backbone of the economy right now, the market is aggressively bidding it up. Which brings us to Section 5, the final investor verdict and actionable takeaways. Because at the end of the day, what does all this data mean for your portfolio tomorrow morning? So the crucial point is this: overall market sentiment is cautiously optimistic. The playbook here is a quality-first approach. You absolutely want to favor the local economic tailwinds, those cyclicals and infrastructure plays we've been tracking, all while keeping a very, very close eye on global interest rate jitters that could spark some sudden volatility. I'll leave you with this question to chew on before the opening bell. Are you positioned for the real economy rotation, or is your portfolio still anchored to yesterday's tech growth stories? It's time to review those allocations, folks, and make sure you're riding the right trends. Thanks so much for joining me on this explainer. Stay sharp, trade smart, and I'll catch you next time.